When stocks plunge, it can be difficult to remain unfazed, but there are some things you mustn't do. First, don't panic sell. In the 1 week between when Donald Trump announced sweeping tariffs and an abrupt tariff pause, US stocks seesawed. If you held on to your positions, chances are your investments would have made some sort of a recovery.
Typically, during a market sell-off, the first reaction that investors will have is to follow the crowd. And that means that we will see a lot of panic selling that's happening, regardless whether there's a change in fundamental, but mainly driven by a change of sentiment.
It's grounded in the phenomenon called recency bias when it comes to investment markets. Unlike when things are on sale on shops, when people run to buy it, in investment markets, when markets are down, things are on sale, people can't run away fast enough. And that's just natural instinct.
History tells us that markets, more often than not, will eventually edge higher. Volatility in the markets is part and parcel of investing. Wall Street's fear gauge shot up after the White House announced reciprocal tariffs on April 2nd. Experts say rather than fearing volatility in the markets, investors could use the opportunity to pick up bargains.
I think it's key for investors to look beyond the noise of the volatilities that we are actually experiencing and looking at the long-term fundamental. Case in point is, I'm sure you will not be selling your house that you've been staying in just because the property prices corrected for the past 3 weeks. And instead, we should actually take a long-term view and understand our objective and goals of what we are trying to achieve through our investment.
It might help if investors also look more carefully at the price equation, the valuation equation. That's one thing very, very often people miss when they look at charts of how markets go up and down. People often don't think like business owners or investors in direct businesses who would be very carefully looking at what is actually the revenue of the company, what is the profit, and how does it relate to price. Price is the missed equation that shoppers are very keen to look at, but not investors.
Careful research is key here. While things may be cheap during a market crash, there is still the risk of trying to catch a falling knife.
I think one of the biggest risks here is actually looking at companies where even though they might show a cheap valuation, but fundamentally they might already show cracks or they are already fundamentally weak. So for instance, their earnings power could have deteriorated, management might have lost its way, or even a company might have seen its debt or leverage starts piling up. This means that when the market starts to recover, you probably wouldn't see these businesses or the shares of these companies recover.
When going hunting for bargain stocks, don't fall prey to value traps. This is when a stock appears to be undervalued, but ultimately doesn't deliver the expected returns.
Not all cheap stocks are a bargain. A couple of reasons. Number one, businesses or companies, they face declining business models. Their operating model might not be as resilient as it was once before. Number two, some of the products, their services, which they sell might be outdated. And the industry could happen to be in a very intense competitive environment, or the industry is seeing a downtrend. Because what's going to happen is that they might be faced with falling revenues, falling profits, and a shrinking of their free cash flow.
When markets are in free fall, going to cash might seem like a safe move. But sitting on cash in the long run is likely to work against you, as inflation will erode your spending power.
Now, cash seems very risk-free. There is no volatility on a daily basis that one sees. But in a way, this fact could even in some ways make it more dangerous, because the potential purchasing power loss or purchasing power erosion that you might see over time when inflation is higher than deposit rates, it doesn't register as a danger because it's so gradual, but it could make it actually in a way more dangerous that way.
For example, investing in global stocks for a period of 10 years would have reaped a 60% higher return compared to holding cash. even if that cash kept a juicy 5% yield compounded over the long term.
It's unlikely that you can achieve your financial goal purely by investing into cash. And there are a few reasons. One, deposit rate, while it was high in the last few years, but we have also started to see a declining trend in terms of interest rate. And number two, the interest that you're getting from cash will never outstrip the inflation that we are experiencing now and in the future. And therefore, I think the key for one to actually achieve your financial goal is to have a diversified portfolios of various asset classes, including cash as one of the components.
During a typical market sell-off, investors tend to shun equities for safer options like bonds or gold. However, remaining outside the stock market for too long could come at a cost.
It is very natural for one to de-risk your portfolio by increasing lower risk assets such as cash, fixed income during market downturns. And I think that's a very sensible thing to do as we weather through the bouts of volatilities. But one cannot ignore the opportunity that presents within the equity markets. And I think this is probably the time for one to go out there to hunt and search for the quality companies that's trading below the intrinsic value and start to take on some positions in your portfolio as we anticipate the next market upturn. Equity is very crucial in one's portfolio because one, the additional risk that you take by investing in the equities will typically lead to a higher outcome.
In this example, an initial investment of $10,000 would have grown to over six-fold if an investor was fully invested for all days. Missing just 10 best days of being in the market, the portfolio would have lost 50% in value. Missing 60 best days, the portfolio would have plunged by 90%. In other words, time in the market beats trying to time the market. Sometimes investors focus on the price they initially paid for stock, making decisions based on that anchor even when the market conditions have changed. Or they create an anchor based on initial information they may have received about a stock, ignoring changes to a company's fundamentals. This anchoring bias could risk widening losses when things turn sour.
One of the cognitive bias that we can talk about is around anchoring. What do we mean by that? Most investors will base on the initial set of information or in fact the entry price of their investments to determine the fair value. This is why you do hear a lot of investors, they are very reluctant to let go of their investments, especially if it's below their entry price. Now, I think that's probably one of the issues that a lot of investors are facing, and because one needs to constantly review their investment thesis to understand whether this sell-off is driven mainly by sentiment or is driven by a change in fundamental. And that cannot be done if you do not have the research behind your decision-making process.
As investors face the market volatility, here are some things to bear in mind about US tariffs.
The US share of global trade is actually 11% right now. 2/3 of the world's countries trade more with China than the US. 20 to 30 years ago, fallout might have been much larger to a lot of other countries. What we might see is more trade integration between non-US countries. Ultimately, there's still good companies that can manage through, particularly those which have stronger balance sheets and can sit out challenges. So we wouldn't suggest investors to speculate on what exactly is going to happen after 90 days. Just sit tight on investments for the medium term.